I will share a bit of overview for the merger. Okay, so KLK is one of Malaysia's leading plantation companies, while IJM was a subsidiary of IJM Corporation, who is also focused on palm oil. In June 2021, KLK announced that they would buy 56.2% stake in IJM Plantation for 1.53 billion ringgit Malaysia, offering 3 ringgit and 10 cents per share. A few months later, in September, the deal was completed and KLK launched a mandatory general offer to buy the remaining shares. By November 2021, KLK owned more than 90% of share and IJM Plantation was delisted from Bursa Malaysia. This was a horizontal merger since both companies were in the same industry, which is palm oil. KLK's landmark increased by about 28.7%, which helped strengthen its upstream operation. The main purpose of the merger was to expand KLK's plantation footprints and unlock operational synergies like cost savings and better efficiency. So in summary, it was a strategic move to make KLK even more competitive in the global palm oil market. So now I will share 5 benefits that they get from this merger. First is the expansion of land bank and operational scale. The merger significantly increased KLK's total planted area, especially in Sabah and Indonesia, enhancing its upstream oil palm operations. This expansion improved economies of scale, reduced unit costs, and boost long-term profitability. Next benefit is synergies in operation. KLK anticipated operational synergies from consolidating estates and mills, improving logistics and procurement, and integrating best practices across both organizations. These synergies are expected to enhance yield, productivity, and operational efficiency. Third is the increased market share and competitive edge. By acquiring IJM Plantations, KLK strengthened its position in the palm oil industry. A larger operational footprint allows KLK to be more competitive globally, especially in light of sustainability and ESG expectations from international buyers. The fourth benefits are long-term shareholder value creation. With enhanced production capacity and cost efficiency, the merger is expected to contribute positively to KLK's earning over long term, creating better returns for shareholders. And lastly, the last benefit is the access to human capital and expertise. IJM Plantations brought in experienced plantation management and technical teams, enriching KLK's human capital and enabling smoother integration and expansion plan.
The merger between KLK and IJM Plantations was structured as a cash acquisition and completed in 2 main stages. The first stage took place on June 11, 2021, where KLK acquired a 56.2% controlling stake in IJM Plantations from its parent IJM Corporation Berhad. The deal was valued at 1.53 billion ringgit or 3 ringgit 10 cents per share, representing a 31.36% premium over the last traded share price. This premium reflects KLK's recognition of the strategic value of IJM Plantations' assets and its intention to gain majority control. Following the first phase, KLK was required to extend a mandatory general offer to all remaining minority shareholders under Bursa Malaysia's rules. The offer remained at 3 ringgit 10 cents per share. And by November 2021, KLK's shareholding rose to over 94.8%, resulting in the delisting of IJM Plantations from Bursa Malaysia and giving KLK full ownership of the company.
Hi everyone, my name is Nurul Alamin Azmi, and in this video, I'll be explaining the motives behind the merger between KLK and IJM Plantation. To begin with, let's understand what a merger is. A merger is when two companies combine to form a single new entity. There are several reasons why companies decide to merge, but the main motive is often to create value, especially for shareholders. When two companies consolidate, they usually generate synergy. This means the combined company becomes more valuable than two companies individually. In other words, the performance of the merged entity is greater than just the sum of its parts. For example, after the merger announcement, IJM Plantation share price went up slightly to 3 ringgit 9 cents, valuing the company at 2.72 billion. Meanwhile, KLK's market capitalization stood at 22.49 billion. This suggests that the market sees potential value in this merger through expected synergy. One of the main motives of this merger is to support KLK long-term strategy, that is to grow its plantation business. According to KLK CEO Tan Sri Lee Oi Hian, the merger is part of their plan to increase planted land area and strengthen their presence in the plantation sector. Thanks to the acquisition, KLK's total all palm planted area grew by 28.7% from 213,401 hectares to 274,688 hectares. This shows KLK's clear intention to scale up its operation. Next, KLK is also aiming for better operational synergy. By combining with IJM plantations, KLK expects to integrate its operations more smoothly, leading to improved efficiency across its all palm value chain. The CEO also stated that the company is looking at ways to cut production costs and boost productivity, which reflects strong efforts in cost control and long-term profitability. Another reason why this merger makes sense is because of the geographic familiarity. KLK is already familiar with the regions where IJM plantations operate, mainly in Sabah and Kalimantan. This makes the integration process easier and reduces risk. It is important to note that this merger was not about diversification. Both companies are in the same industry. Instead, it is about strengthening KLK's existing business by scaling up operations and becoming more efficient. Hi everyone, now I'll be explaining some of the drawbacks of the merger between KLK and IJM Plantation. While this merger often offers long-term strategic benefits, there are a few important challenges that may affect KLK in the short and medium term. Firstly, the merger is expected to be earnings neutral in the short term. According to Maybank Investment Bank, the acquisition will not significantly improve KLK's earnings right away. This might worry shareholders and investors because they usually expect immediate financial benefits from large deals like this. As a result, the lack of short-term profit growth could impact market sentiment and possibly affect KLK's stock performance in the near future, according to Maybank IB Research in 2021. Secondly, the merger will lead to a large increase in KLK's financial leverage. The deal is valued at 2.73 billion and will be funded through a mix of internal resources and bank borrowings. Because of this, KLK's net gearing ratio will increase from 0.22 times to 0.55 times. The higher debt level brings greater financial risk, especially if interest rates go up or if revenue from IJM Plantation is lower than expected. It could also reduce KLK's ability to invest in other future opportunities, according to Maybank IB Research in 2021. Next, there are also external risks in the palm oil industry that could affect the long-term success of this merger. These include unpredictable weather that could reduce palm oil yields. Other than that, volatile crude palm oil prices and unfavorable policies from both the Malaysian and Indonesian governments. There is also pressure from international environmental and trade policies, especially from importing countries, which may lower the global demand for palm oil. All of these factors could threaten the expected financial returns from the merger, according to Maybank IB Research in 2021. In conclusion, while the KLK-IJM mergers support KLK long-term growth strategy, it is not without risk. The main concerns include no short-term earning boost, higher debt level, and exposure to external industry risks.
Now, let's look at whether the merger was successful, starting with the first key aspect, which is financial performance and market response. The market responded very positively to KLK's acquisition offer, with IJM Plantation's share price jumping nearly 24%, reaching its highest level in over 3 years. Analysts widely regarded the RM3.10 per share offer as fair and attractive, providing a solid premium above intrinsic value estimates. Strategically, KLK gained a significant boost by expanding its planted area by nearly 29%, giving it an edge over industry rivals like IOI, and Genting plantations. Financially, the deal is projected to lift annual earnings by 6% to 12% alongside generating synergies through operational efficiencies and resource optimization. The next aspect would be from the shareholder and regulatory perspective. The offer was reviewed by Kenanga Investment Bank, which recommended that minority shareholders to accept it. The price was viewed as reasonable, especially given IJM Plantation's low trading liquidity and the lack of alternative buyers. For IJM Corporation, this divestment aligned with its shift toward core sectors like construction. KLK shareholders were initially cautious about increased borrowing levels, but market confidence remained strong as reflected by stable post-deal share prices. In conclusion, the KLK-IJM merger was not only well-structured, but also executed with strategic clarity. The transaction, through its two-stage structure, allowed KLK to secure control, consolidate ownership, and delist IJM Plantations. Market analysts and investors viewed the deal favorably, and the financial and operational targets set by KLK have largely been met. The expanded plantation base has contributed to revenue and earnings growth, and synergies in procurement and operations have started to materialize. Although KLK continues to face challenges, particularly in sustainability certification and estate rehabilitation, the overall sentiment remains highly positive, reflecting strong confidence in the company's strategic direction.
So what could I conclude for the whole merger KLK and also IJM? So I could outline 4 conclusions for this merger, which is strategy, growth and synergy, financial and market influence, challenges and risks, and also positive viewpoint. As for the strategy, growth and synergy, the merger created operational synergies in logistics, procurement, and best integration, contributing to long-term efficiency and also cost reduction. Well, the second one is financial and market influence, which the financial and market influence responded positively to the offer, price attractive, whereby the transaction was viewed as fair and beneficial to both companies' stakeholders. There are also challenges and risks. While it shows increased financial leverage and exposure to industry risks such as palm oil price, volatility, and sustainable pressures. However, KLK maintained a strong financial profile and credit rating, helping mitigate this risk. I could also conclude positive viewpoint, which is of post-merger KLK recorded revenue and earnings growth and continued working on ESG integration and operational improvement, where shareholder and market sentiment remained broadly supportive. Ultimately, despite some drawbacks, especially in the short-term financial, the merger is targetedly seen as successful and strategic move that could promising a stronger market positioning for KLK.